In this section, we will discuss the latest speech by John Williams, the president of the Federal Reserve Bank of New York, and what it means for the future of interest rates in the EU. Williams is one of the most influential members of the Fed's policymaking committee, and his views often reflect those of the Fed Chair Jerome Powell. On Tuesday, May 9th, Williams gave a speech at an online event hosted by the Economic Club of New York, where he addressed the current state of the economy and the Fed's monetary policy. Williams acknowledged that inflation has been running well above the Fed's 2% target for several months, driven by supply chain disruptions, labor shortages, and strong consumer demand. He said that inflation is likely to remain elevated for some time, but he expects it to moderate as these transitory factors fade. He also said that the Fed has been raising interest rates at a rapid pace to prevent inflation from becoming entrenched and to maintain price stability. The Fed has hiked its benchmark rate 4 times since June 2022, from 0.25% to 1.25%, and has signaled 2 more rate increases this year. However, Williams did not say whether more rate rises will be needed beyond 2023 or how high the Fed will ultimately lift its policy rate. He said that this will depend on how the economy and inflation evolve, and that the Fed will adjust its policy as needed based on incoming data. He also cautioned that there is a lag between when the Fed changes interest rates and when those actions affect the economy. He said that it will take time for past rate increases to slow down economic activity and inflation, and that the Fed needs to be forward-looking and anticipate future developments. Williams also discussed some of the risks and uncertainties facing the economy, such as the ongoing pandemic, geopolitical tensions, fiscal policy changes, and financial market conditions. He said that these factors could have significant implications for economic growth and inflation, and that the Fed needs to be flexible and ready to respond to any shocks or surprises. He also mentioned that the Fed could lower interest rates in 2024 if inflation pressures ease and economic conditions warrant it. He said that this is not a prediction or a promise, but a possibility based on his current outlook. In summary, Williams did not say whether more rate rises will be needed after 2023 or how high interest rates will go in the long run. He said that this will depend on how the economy and inflation evolve, and that the Fed will adjust its policy accordingly based on incoming data. He also said that it will take time for past rate increases to slow down economic activity and inflation, and that the Fed needs to be forward-looking and proactive. He also acknowledged some of the risks and uncertainties facing the economy, and said that the Fed could lower interest rates in 2024 if conditions change. One of the key challenges that the Federal Reserve faces in its monetary policy decisions is the lag between when it changes interest rates and when those changes affect the economy and inflation. This means that the Fed has to act based on its forecasts of where the economy and inflation are headed, not just where they are today. In his speech on Tuesday, New York Fed President John Williams explained why it will take time for the past increases in interest rates to slow down economic activity and inflation, which have been running at high levels for months. He said that changes in lending conditions, such as higher mortgage rates and tighter credit standards, are one of the main channels through which monetary policy affects the economy. But these changes do not happen overnight, and they also depend on other factors, such as consumer confidence and expectations. Williams said that the Fed's rapid rate increases since June 2022 have already started to have some effects on lending conditions, but that it will take several quarters for these effects to fully show up in economic activity and hiring. He also said that inflation is influenced by many factors beyond monetary policy, such as supply shocks, global demand, and wage pressures. He noted that some of these factors are likely to fade over time, but that others may persist or intensify. Williams said that the Fed will closely monitor how lending conditions and their potential effects on economic activity and hiring evolve over time, as well as how inflation expectations and actual inflation respond to monetary policy actions. He said that the Fed will adjust its policy stance as needed to achieve its dual mandate of maximum employment and price stability. He did not say whether more rate rises will be needed, but he indicated that the Fed is prepared to act decisively if inflation remains too high or if the economy slows down more than expected. The lag between when the Fed raises interest rates and when those actions slow down the economy is one of the key challenges that the central bank faces in its fight against high inflation. In his speech on May 9, 2023, New York Fed President John Williams said that it will take time for the Fed's rapid rate increases to slow down economic activity and inflation. He also said that changes in lending conditions and their potential effects on economic activity and hiring would be a top focus as officials determine whether they have raised rates enough to bring inflation down. The Fed has raised its benchmark interest rate 4 times since November 2022, from 0.25% to 1.25%, in response to surging inflation that reached 7% in December 2022, the highest level since 1982. The Fed has also accelerated the tapering of its bond buying program, which is expected to end by March 2023. These actions are intended to reduce the amount of money and credit in the economy and make borrowing more expensive, which should eventually dampen demand and lower price pressures. However, the effects of monetary policy are not immediate or uniform. They depend on various factors, such as how consumers and businesses react to higher interest rates, how financial markets adjust to changing expectations, how long-term inflation expectations evolve, and how other shocks affect the economy. According to Williams, it can take up to 2 years for the full impact of monetary policy actions to be felt on inflation. This means that the Fed has to act based on forecasts and projections, rather than current data, and be prepared to adjust its policy stance as new information becomes available. One of the risks that the Fed faces is that it may overshoot or undershoot its policy goals. If it raises rates too much or too fast, it could cause a recession or a financial crisis. If it raises rates too little or too slow, it could fail to contain inflation or lose credibility. Williams said that the Fed is monitoring a range of indicators to assess the state of the economy and the outlook for inflation. He also said that he expects inflation to moderate over time as supply chain disruptions ease and pandemic-related spending shifts subside. He did not say whether more rate rises will be needed, but he hinted at a possible rate cut in 2024 if inflation falls below the Fed's 2% target. The lag between when the Fed raises interest rates and when those actions slow down the economy is a complex and uncertain phenomenon that poses significant challenges for monetary policy. Williams' speech highlighted some of the factors that the Fed considers in its decision-making process and some of the scenarios that it anticipates in its policy outlook. His speech also showed that the Fed is flexible and data-dependent in its approach and that it is ready to change course if needed.